to this breakout, the mother of all breakouts in the plenary, so that's more important than the other ones, and for the good reason that we're going to talk about an impactful climate tech portfolio. Moderation will be by Marij Wagenaar of the UN Global Compact Network, and the two absolute cracks discussing how to build a climate tech portfolio are Rickert Berenkamp, Carbon Equity, and Oyin Oduya of Wellington. So give them a hand. I don't know where they are. They'll be on stage real soon. There we go. Zet hem op, hè?
Well, welcome. Please take a seat. And we're almost at the end of the program. And it's dark. I just thought maybe it's better to come a little bit more to the front, because actually we wanted to make it a very interactive session and that you're not dozing off at the end of the day. So we thought, please move a bit forward. We won't eat you. I think people already, there's room at this table, over there as well. Because I think the nice thing is we have two great panelists and we can have a lot of interaction. They also said like it would be great to really discuss with each other. In the briefing we were told we're doing a breakout. I didn't expect it to be in this huge hallway. But I think for now, there are still some people in the back. Don't you want to come forward? Or are you leaving somewhere soon? So be welcome to come to the front, but good to see you all. For this session, we will have a dive into the world of asset owners, asset managers, sharing their opportunities and the challenges they encountered in climate technology strategies. Oyin Oduya, I hope I said it right, and Rickert Berenkamp are joining us. I will ask you later on to introduce yourself and already with some questions. But first of all, because you were so kind of getting to the front, I would like to know who you are as well. And I think there are some like colorful things on the tables, but is there a set for everyone? Okay, perfect. Because just to get an idea, like who would be the asset owners in this audience? Just raise hand high. Yeah, it's terribly dark. Okay, good to see. Almost, well, half. And asset managers? Okay. A little bit less, but good to see others. Not, and one of the two, well, that is nice. Normally we have a lot of like others and then you have to ask what are you doing exactly, but great. Okay, I think we're set to go. My name is Marij Wagenaar. I'm the executive director of the Dutch network of UN Global Compact. It's a multi-stakeholder initiative that encouraged companies to align with the UN values, principles, and to work on the SDGs. To start this forum, I think it's nice to mention as well that the United Nations actually estimated in a study they did last year that about $3 to $5 trillion annually is needed to meet the Sustainable Development Goals by 2030. For those who are not aware with it, luckily I see some of these colorful pins, but those are the 70 goals on getting rid of poverty, having a healthy living environment, having a living wage, gender equality, like all these things we really want to achieve, but one way or the other we cannot do alone. And I think business and finance is key in achieving those goals. And as UN Global Compact, we see corporate finance and investment as a catalyst for growth and social impact. But that is a kind of an introduction. I would like to introduce you as well, but I would like to have it both telling you a bit more about your company and the things you're doing. So, Ojit, you're working for Impact Measurements and Management Practice Leader at Wellington Management. It's a mouthful, I hope I say it correctly. But what sort of companies does Wellington look for? And how do they demonstrate the potential in the field of climate tech?
Sure, thank you. And thank you everyone for being here. As mentioned, I lead the impact measurement and management practice at Wellington Management, a very big mouthful. Wellington Management is a global and diversified asset manager with over $1 trillion AUM. On our sustainable investment platform, we have impact strategies across public equity, public fixed income, and private equity. And so I'll focus my comments today on our private climate tech impact approach, where we focus on helping companies to grow and scale, where their businesses are solely focused on either climate mitigation, so helping to reduce or avoid CO2 emissions, and also climate adaptation, so helping the world to become more resilient to the effects of climate change. The role of the impact measurement and management practice across all the portfolio managers that we work with is really all about data. I think the bar in sustainable and impact investing is getting higher and higher, as I think we all know. And increasingly people are saying, well, if your impact, prove it. Where's the data? And so that's really what impact measurement and management is all about. We help investors who have a dual mandate to generate attractive financial returns alongside measurable social and environmental impact to get the data that shows that impact, and not just to report it, to keep us accountable, although that's an important part of what we do, but to analyze the data, to look at trends and try and use those trends to influence the investment process, to influence our portfolio companies, and to kind of help hopefully grow the impact investing ecosystem. So that's kind of me and what I do in a nutshell.
Well, very nice. Thanks for that introduction, and I'm really looking forward to having a deep dive in this session.
Well, but let me talk about the climate tech. Yeah. Let me address the second half of your question as well. Sorry, my intro is maybe too long. So in terms of the sorts of companies we invest in, that's a very important question to make sure that I answer. In the private climate tech approach, as I said, we focus on mitigation and adaptation, and we make sure that we have a very kind of repeatable process for kind of selecting companies into the universe and ultimately into the portfolio. And so we developed alongside the investment team a climate materiality framework that we run all our companies through. And the easiest way to think about it, I think, is just using an example of a real life company rather than talking about it in abstract. So I helped to diligence a company which essentially produces software and hardware to create robots that help to sort waste more efficiently, using kind of AI and very advanced technology. And so the first stage you would do as in this strategy is to think about framing the problem. We know that up to 40% of waste that actually is put out for recycling actually isn't recycled because it's a very inefficient process. A lot of that ends up in landfill, and then you have methane emissions, and of course that's not good for the environment. So we know that there's a big problem to solve. And then we have to think about how this company can help to come up with the solution. It's very advanced technology, as I mentioned. They can sort waste 3 times faster than a human with a 99% sorting accuracy. So the thesis is, the theory of change, as many of you will know, is more waste gets sorted more efficiently. That's better for the environment and can support the circular economy. Then we have to think about measurement. So from a top-down point of view, if this company were to scale, could we really quantify the amount of CO2 emissions they may avoid on a large-scale basis and deem that to be significant relative to country emissions or industry emissions? But we also have to think about bottom-up on a quarter-by-quarter basis. What are we measuring in terms of the KPI for that company? And then lastly, I think one of the most important things is to consider, is this company's growth drivers aligned with climate impacts? Now, for this company, all they do is make robots that sort waste. So the more robots they sell, the more climate impact there is. It's a very simple case to say, yes, if this company grows, it makes money for themselves, it makes money for our portfolio, then of course you're going to see more climate impact. But I think getting that collinearity between business growth and climate impact is actually, it's simple to say, but it really is very important to kind of establish at the beginning of diligence. So that's the sort of companies that we invest in, companies that have climate impact baked into the heart of what they do.
Well, very nice as an introduction. And what I wondered, I was just maybe some of you also joined a session on circularity and the impact management upstairs, like one of the breakouts before. And like sorting the waste was seen as one of the biggest challenges. Do you also look at how it connects to other challenges? Like it has a climate impact, but how does it connect, for example, to circularity? Like, are you also taking that into account, or are you just saying, well, it's our tech portfolio, so we scored a company on that aspect?
No, you have to take a very holistic view of impact, I think. And when we were looking at some of the diligence that went into it, we really take a fundamental approach. So we actually spoke to experts in the fast-moving consumer goods industries who have made all these pledges that their packaging is going to be sustainably sourced by 2030, but actually there's a real dearth of recycled plastic feedstock available, and that's exactly what this company is helping to produce. So saying, yes, they're doing this better and faster and there's less landfill, but also the quality of the bales of the recycled materials that they produced are higher quality and can go into trying to solve that kind of lack of supply. So that's one, definitely we consider the whole value chain. The other thing to think about is the social impact, right? Yeah. There's a big climate benefit here, but also the jobs of the people who are kind of sorting this waste are dangerous, they can be dirty, they're not very well paid jobs. And so actually you can say moving these to kind of AI-enabled technology is a good thing, but of course, jobs are also being lost. Yeah. So having to think about all these kind of different interconnected issues, I think is an important part of being an impact fund, because not just simple as kind of problem solution, there's an ecosystem to consider, there are negative and positive externalities to consider, and that all plays a part in our diligence process.
Nice. I think very rich example. Thanks for that. Rickert, over to you. You're working as you're the head of the professional solutions, it was called, at Carbon Equity. Could you tell a little bit more about that, and also what kind of manager are you looking for? What is, do you have a business case
I'll
there?
First, say that actually I'm replacing our CEO, which is Jacqueline van den Ende, the founder of Carbon Equity, and I think it's a good thing because she's also female. Now I bring a bit of the diversity to our panel, so I think that's good. Now, Carbon Equity actually, basically what we believe is that the climate transition is the biggest generational investment opportunity for the coming decade, where I would say impact, you already explained it a bit, impact and returns really converge. We do believe that you need to decarbonize really the entire economy. So it's not just about the energy transition, but it's also about providing more efficient housing, e-fuel transport, food and ag, and even also carbon capture. Now we see that this is now becoming investable. I mean, through funds that invest directly, but yeah, we see this market really maturing. So there's a lot of climate-focused funds in the market that are becoming kind of more mature. We also see that it's still challenging to invest in this asset class, because I would say the solutions, they go through to the entire economy, as I said. So it means it's difficult to see already who will be the winners, who will be kind of the losers. So you need to really invest in a diversified way. And that is, for a single investor, still kind of a challenge. You also need to get access to the right funds. It means that you need to bring at least a certain amount of capital, and you need to select the right managers. Now, Carbon Equity tries to unlock this opportunity by pooling the capital of many investors together into a single fund, and that fund invests in underlying funds that are dedicated to the climate transition. We invest both in the US and in Europe. We also invest through stages, so not just early stage, but also growth equity and later stage. And that's what we unlock. For those investors, we have a dedicated team of 8 professionals that's only focused on this topic, on selecting these funds, which means that we have really both a lot of investment skills, but also domain knowledge on the topic, which is really important. And investors invest with us either because they agree with us that this is the biggest investment opportunity and they just go for outsized returns. And we have investors that, what we say, do good by investing better. Now, to date, we're still young. We're still not in the size at Wellington. We're just very small, 200 million funds under management. Started 4 years ago. We raised that from 700 investors. And we've already invested now in 15 climate transition funds that have already invested in over 100 companies. And I would say that, those 100 companies are quite promising because if you look at the statistics and the data, they've already raised more than 2.4 billion after we invested. We also see already 4 unicorns in portfolio, so we are very excited, and we see kind of the traction, the track record being built up in climate transition, which I think will hopefully attract more investors in the future.
Yes, well, thank you so much. And I think this is also key in how can you develop really a business case? Because do you have an example of a business case where you said, well, here it really worked in a good way, or you're still too early for that?
Yeah, no, for sure. I think that, there's many topics, and I really like to kind of explain our product to potential investors, because there's so many cool companies being founded and being and growing. One of them, for example, is a company where we are invested in, is Form Energy. Form Energy, they create large-scale batteries. And large-scale batteries you need to balance the grid, because we're still more and more dependent on renewables. And this company, and it's actually quite interesting, they use kind of quite an old technique. So it's an iron air battery solution that's actually rusting and derusting if you put electricity to it or you take electricity out. That's 10% more, it's 10% of the cost of lithium batteries, and it can use renewable materials. So it's really a cool solution. This company already has raised 800 million. They're already, in terms of valuation, a unicorn. What is really interesting to see here also is that over the last year, they got more than 200 million of grants in the US from the Inflation Reduction Act, from 4 different states. So you see that a lot of people are now starting to compete to get that technology to in their home state. And I think this is kind of one of the examples where, the technology is kind of very easy scalable, because you don't need rare minerals to produce batteries. It's fully recyclable, and it's so much more efficient than you can kind of the more expensive solutions.
Yeah, I think it's a great example just to see, okay, how can a company like this grow and really attract capital, because that is one of the,
and for us, it's interesting because, for example, 4 of our funds are actually in the cap table of this company. So we can do really good due diligence. We can compare kind of all the different business cases, which makes us for us also kind of an example in the portfolio.
Yeah. Well, moving to you, because I promised to make it interactive, and I will do so. Just first of all, who is already into impact investing, having already like a portfolio in this area? If you just raise hands, already quite a crowd. Well, probably being here as well. But the reasons, what do you consider like the main reasons that people are not investing yet? And now we can use the colors. I was looking forward to that already for a while. Would that be, they're all a bit the same, huh? Like the red one, would it be that there's no proven track record yet, like the risk that involves in the track record? Would it be blue one, the risk of greenwashing, that you think, well, I'm investing in it, but I'm not sure what the real impact is? Or are there other reasons, the purple one of the, let's call it purple. Could you please raise how you would rank it? What would be the reason, either for yourself or for others, that you see that people are not investing in like the impact and doing those impact investments? Would that be the not a track record yet, greenwashing, or are there other reasons? holding up the...
Which are
and
the
we
colors?
I think the colours are just on
Oh,
the screen there,
perfect.
so we have them. I think we can follow
Oh,
the one
yeah.
on, they're on there.
Sorry,
Yeah.
I didn't look at it.
Thanks so much. Oh, so, but they changed the, and there's a yellow one. Okay.
Okay.
Doesn't make it more grim. Performance, lack of track record, greenwashing, and something else. It's yellow on the screen, but orange in, like combination of colors. I see quite a lot of like other. So is there a microphone? There should be somebody walking with a microphone. Yes, perfect. Could you, like, who had orange one? Because I'm very curious what other reasons there are not performing. There's one completely in the back, but that would be more. Oh, I thought actually we could do the people in front.
I think also a lot of investors, especially not the very large ones, are struggling with different definitions, the measurement, what framework to follow, etc. So from what I can see, at least, a lot of institutional investors are still trying to figure out the exact how and why. So I think they may have made the decision that they want to allocate more, but then the next thing is how do you do it, how do you build it into your processes, etc.
Yeah. So you're saying like the how and why of investment is not clear enough. I think that would be a nice one to address in a moment. I'll just, while we're on it, somebody said like what the risk of greenwashing, the reputational risk. I saw some blue ones. Yes, I think here in the front, have a good exercise here with this size of the... Maybe it's good to state your name and organization first. It might be interesting.
So it's on. I'm Matthew Gardner. I'm from A1AI, which is a green investment fund, and also been working with the City of Amsterdam. I think for more sophisticated investors, they are aware they may have some reputational risks queuing up anyway, and they're aware of the lack of clarity being a reputational risk in itself, and also compound risk. So investing early to be in compliance with CSRD, all those kind of things, but then concerned that their investment is going to have a compound risk and an adverse effect, which will take them out of regulation. So no real guidance around that because there's no metric to base anything on, so kind of sliding them out all over the place and denying there's a crisis as a result. It's cognitive overload. Cognitive overload,
Yeah.
to say it slowly.
I think that's a nice one as well. But Rickert, maybe
Well,
you would
I
like
think
to
it's
react
more like,
first?
you know, we probably have two different answers in the sense that we are a fund of funds. So we don't directly invest in companies, so we don't really have direct control over kind of the investments that we invest in. However, so we need to really kind of do our due diligence up front on the manager. And that means that we are very diligent in focus. We've developed our own framework on that. We really focus on kind of the intentionality and the strategy, the impact strategy, the impact, how they integrate kind of impact in their investment decision making, how they have report also on the impact. And there we have developed a questionnaire where on each of those topics we ask kind of 4 or 5 questions. And because we see all the funds in the market, I mean, we've now tracked more than 450 funds. So we really can tell what is a bit kind of best practice. And that's how we kind of benchmark the answers to, I would say, the best practice. And then obviously it's about engagement with the manager. So we try to really kind of sit down and then we even share our kind of observations with them. That's, I would say, 50% of what we do. The other 50% is really focusing on the actual investments. So do the investments that they've made kind of align with their strategy? And that's how we kind of develop the framework where we really kind of see each investment, does it kind of meet any of the, I would say, critical solutions to get to net zero? And there's kind of several organizations that have mapped it out. And then we actually check if there's kind of real substantial contribution to those technologies. And that in the end needs to be at least 80% of what they've done in the past should meet those criteria. And only then we can invest. And obviously once we invest, we track And now we're quite happy that 92% of all the underlying investments actually meet kind of our minimum criteria. So that's, I think, a good achievement. But that is, I would say, totally different than what you would do, because you actually look at the underlying portfolio companies yourself.
Yeah, and how is it then, if you look from a Wellington perspective?
Yeah, well, I do have sympathy for the point of view that it's difficult to get up to speed into how to analyze what is a good impact fund, because we have our own framework that we've developed, you have your own framework you developed, all impact managers will have their own framework. And in some ways it's helpful, and it's trying to combat that issue of greenwashing and reputational risk that can come alongside putting companies in a portfolio. You're saying they're doing good. If the proof point is lacking, if the evidence is lacking, that is a reputational risk. And increasingly that's becoming a regulatory risk. And so that's why people have sometimes these very detailed, complex frameworks to show, yeah, okay, we're doing our diligence. You know you have impactful companies in this climate tech portfolio, but it does make it a little bit complex. So I'd say that what we try to do to make it easier for potential clients looking at our impact approaches, and particularly this climate tech approach, is to align as much as possible as we can with impact best practice. Now, I've been working in impact investing since kind of 2015, 2016. You wouldn't believe it, but we have moved a very long way from when we first started. There are many more frameworks available now which are common across different impact funds, where we think about the impact frontiers, 5 dimensions of impact, originally the Impact Management Project. We can think about the list of metrics from the GIN, IRIS Plus, and actually there's some very specific climate tech focused frameworks. So for example, I've participated in many working groups from Project Frame, and this is a coalition of impact-focused VC funds who are focused on the very specific task of forecasting forward-looking climate impact, which is difficult but actually quite important, because when you're thinking about climate tech solutions, you're not just thinking about what is this individual company doing during the kind of 4 or 5 year investment period that I may be holding the company. You're thinking about what could the long-term impact of this company be in terms of disrupting energy supply, disrupting animal husbandry, or disrupting kind of, insulation in the building industry. So you have to really think about that forward-looking analysis, but there are so many different ways in which you can do that. What's your baseline? What are your emissions factors? What's the counterfactual? And so Project Frame is trying to bring together climate tech focused VCs to say, okay, let's try and do this in a similar way. So it doesn't 100% solve the problem of having to look at kind of individual fund frameworks that may be slightly different, but you can have little markers that say, oh, I've seen Impact Management Project 5 Dimensions, I've seen Project Frame. That means there's some sort of coalition towards some sort of industry best practice, and those, I think, are kind of signs that it's a manager that takes impact quite seriously. I guess one final thing that I'll say is I sometimes think that impact, we beat ourselves a little bit too much on this consistency, because if you think about, even in public markets, what's the definition of a quality growth stock? Or in private markets, the definition of early growth versus venture, you do have some level of objectivity in kind of defining where you play, and I think that we can do that in impact investing, and we should, be focused maybe more on educating clients on, what the different frameworks can look like, so that it doesn't feel so overwhelming to compare. The reality is that in traditional finance, you have to think about how does the manager think about investing, what are their opportunity set, and there is some objectivity there, and so I don't think that in impact we're going to get to some amazing destination where everything is the same. There's always going to be some nuance.
And I think you're touching upon like a crucial point here, how to learn along the way. Like it is something that is developing, you're learning along the way, and how do you also educate your clients and educate the people you're working with. And maybe that's back to the question at the end.
I'm really curious. No, this is a nice, I would say, topic to discuss, because I also see a bit kind of the downside of it, in the sense that we've invested in so many kind of early stage companies where impact is really hardly even possible to measure, because there's still no revenue. There's no kind of clear pathway to impact, and I think we should also be a bit kind of, I would say, kind of cautious to not raise expectations that everything you can measure and everything that you can predict in the future. And that's kind of, from an institutional investor perspective, kind of the new kind of, they need to have that in place before they can invest. I think then we will miss out on many, I would say, very interesting, promising in investment. By the way, our Chief Impact Officer is part of Project Frame, so I should be careful what I say here. But I would really be cautious to do not make it too complex. And that's also, if you look at our approach, where we just say kind of it needs to be at least contributing to one of the critical net zero technologies, and it needs to be sustainable. And that's then for us at this moment in time kind of enough.
And I think it is also something that will develop more, and when you get more insights, it's easier to do as well.
I mean, we have in many of the investments, there's multiple funds kind of that we invest in the cap table. If they all kind of claim, you know, the impact on that company, then we will kind of blow up I would say the impact of that company. So I think it's good to come to some sort of a kind of measurement.
And if you're coming back to the question that we had completely at the end, and I see a hand there, so I think I'll first take the question here, and then we come to the explanation of how and why. I think that is key, like how would you pitch that? But we first go to question, because maybe you can state first name and organization. Yeah, perfect.
I don't know if it works. Oh, yeah. Hi, my name is Mies, work at ASR Asset Management. I have a question for Rickard. You state that you analyze within a fund you invest in, you analyze each investment, whether it's in line with their strategy or KPIs or not. But you invest mostly in private markets. What do you do when it's not the case?
So, the last question I didn't hear.
What do you do if that's not the case? If there
I mean, let's put it this way: we have the minimum threshold, and if they don't meet the minimum threshold, in principle, we will not invest. I mean, that's just we can select more funds, so that's one. We are actually also there to I would say develop this industry. So we also kind of give our view on how they can improve on what they've done. I think that is one, and then we also track those funds over time. So if we're kind of not investing today, doesn't mean we'll invest in the next fund. What we sometimes also do, if there's not enough proof yet, is that we just wait for the final close, the final close of the fund, where they have already made some investments in that fund, and then we have a better view on if they would kind of meet that or not. It's, by the way, also fair to say that if they don't meet our criteria, doesn't mean it's not an impact fund. So because we focus really on decarbonization, it can mean that they have other kind of impacts that they achieve with those investments. They're still good investments.
And if you are already invested within the fund, because you monitor and you track.
Yeah. Obviously, then we can't influence it. So it means that that we kind of just track. I mean, we have kind of an 80% threshold. Most of the funds are way beyond that. So we haven't, I would say, had that problem yet. I mean, it will ultimately mean that we will not invest in the next fund. But we can't change the current portfolio, of course.
And would it also imply that at a certain stage you would divest? You would take your money out of it again?
That's kind of, that's a good question. I mean, I know there's a kind of an impact secondary fund walking around as well, so that is more and more the case. I mean, we would rather spend more time and kind of more energy with the manager to help them to do better than to immediately divest.
Yeah. To really develop it together, to learn, to educate as well, to get it going. And maybe coming back, well, now finally, thank you for your patience, on the unclarity in the how and the why of impact investment. What would you say to somebody who said, like, well, it's not so clear for me what is the how and the why of the impact investment?
I think that it really comes down to impact governance, and that may not be kind of the most exciting topic, the rules and regulations and policies that a manager sets themselves, but it's really important because you can have a certain amount of subjectivity in putting together an impact case, but it's really important to understand, well, who makes the decision? who's on the investment committee. So for example, I sit on the investment committee for our private climate impact approach. If a company is no longer meeting the requirements of the fund, what happens? So in the case of our approach, like we can't do follow-on investments in a company that doesn't continue to meet the impact criteria of the fund. You know, how are you considering impact risks, negative externalities, ESG, for example? So I think really trying to understand like what are the parameters to make sure that the right things are going into the fund is really a critical thing to think about. The other thing is the quality of the evidence base. As I mentioned, in this era of kind of climate tech, of impact investing, a lot of the data we're putting together is estimation. We don't know 100% how these companies are going to turn out and how the climate impact will be realized. And so just making sure that there's a robust evidence base there is very crucial. So I think for us at Wellington in these kind of impact approaches, one of the value adds that we can bring is the strength of the Wellington platform. So we're known as a very fundamental bottom-up investor when it comes to kind of really researching stocks, and that applies on the private side as well to portfolio companies. And it also applies to considerations of climate risk and opportunity. So we have a very well-stocked climate research team. We have a partnership with Woodwell, which is a think tank in the US specializing on the physical risks of climate change. We also have a partnership with MIT on the energy transition. So we're really trying to bring in good fundamental research so that when I am, for example, diligencing a company that is developing a drought-resistant seed, I can go to a climate scientist and say, does this technology work? And then I can go to a real specialist who looks at kind of farm equipment companies and says, well, if the technology works, are they going to actually sell this to customers? Is there demand from it? Are they going to make money from it? So really trying to take that fundamental view. And those sorts of resources are industry analysts, are climate science partnerships. We share those with our portfolio companies in order to help them to really demonstrate and create value which is related to climate. So again, just having, and I appreciate that not everyone has access to those resources, but everyone can demonstrate, well, here is our evidence base, here is the governance, here's the why, here are the guardrails to make sure the right things are in the portfolio.
Time's up.
Sorry, there's no time, let me be quiet and let you also answer that.
I'll keep it short. I mean, I've been starting investing in impact investing 5 years ago, and I think then, everybody, a lot of people I was meeting really saw impact as where can I lose my money? Yeah, and I think that kind of mentality has really changed. I think a lot of people now recognize that you can really make impact and returns. And I think that the macro trends where a lot of the impact is coming from are really there to stay, and they're huge, and they have a lot of tailwind from government support, consumers, changing consumer behavior, corporate pledges. I think that really, I would say, the time to invest is now.
Yeah. And I think that is because we know the time is up. We started a little later.
We did start a bit later.
Yeah, we did
Like,
start. So we just squeeze it a little, but we have to get to the
shouldn't
next
be
session.
short.
Yeah. But I think it is something very important that you say. You say, well, the time to invest is now because we do see that there are huge opportunities as well. Like there are some.
There's a huge momentum, and it's kind of. I think that kind of the impact and returns are really kind of obvious, almost. So you almost kind of sometimes have a kind of when I talk to potential investors, almost like why can't you say no?
Yeah, I do think we need to be careful though of just trying to boil impact down just to one big number. I think people are very focused on what CO2 emissions are you avoiding, what are the kind of the big macro impacts of the portfolio. But as I think the discussion we've had today shows, impact is really multifaceted. It's not just about the number, it's about the process. It's about integrating impact into how you invest. It's about really engaging with the portfolio company to maximize the real world impact. And so you really have to think about all those elements to have an impactful climate tech portfolio.
Well, and before Pete is kicking us off stage, I want to thank you very much because I think it's very insightful that how your funds work and how you do these investments. And I hope, you will be around during the drinks. And so please give them a big hand and we'll finish up.
Thank you.